good afternoon, good evening, good night, wherever in the world you are. Welcome to a session, the opening live session of the BIS Innovation Summit. My name's Gillian Tett. I'm with the Financial Times, and I'm absolutely delighted to be moderating a session with Augustin Carstens, head of the BIS, Jay Powell, chair of the Federal Reserve, and Jens Wiedemann of the Bundesbank. And we're discussing an issue which is absolutely crucial, which is a degree to which central banks can or cannot innovate to keep pace with the remarkable changes underway in the nature of money today. 30 years ago, Lou Gerstner wrote a great book, the former CEO of IBM, asking, who says elephants can't dance? And in many ways, that's the same challenge for central bankers today. Who says that central bankers can't be cool? Because what we've seen unfold in the last couple of years in relation to digital currencies and other forms of innovation in finance is really quite remarkable. To many people, looking at what's happening with Bitcoin, Dogecoin, all of the dramas around Elon Musk, it looks pretty terrifying. To others, it looks pretty inevitable and something that investors of all stripes and policymakers will need to embrace. But what we're certainly seeing at the Financial Times is obsessive interest amongst our readers in these developments and innovations. In fact, I often joke that Bitcoin for the financial markets is a bit like Kim Kardashian for everyone else, which is a story that grabs eyeballs immediately. So what are central bankers going to do? If you can't beat them, are they going to join them? Are they going to try and displace innovations like Bitcoin? Should they try and curb them? As India has announced just this morning with its new bill to try and ban cryptocurrencies, how exactly should the policymakers respond? And what about other innovations like AI? So, Augustin, I'd like to start with you from the point of view of the BIS. Now, the BIS is not a place normally associated with elephants dancing, with central bankers being wildly cool, and yet you have created this BIS Innovation Hub, which is global. A lot of the activity is happening in Asia right now, in an effort to try and catch up. But at the same time, you personally have been quite negative about many of the private sector innovations. In fact, you recently gave a speech saying that yesterday's failed money types in digital form seemed to pose some challenges, and you suggested that a CBDC, a central bank digital currency, could be more effective as a path forward. Tell us what you're doing at the BIS to try and deal with these challenges. And do you really think that a CBDC is the way forward and could potentially displace the need for things like Bitcoin?
Well, thank you very much, Gillian. It's also a pleasure for me to be in this panel. Well, the BIS is doing many things in this space, the technology space. We owe the BIS owe itself to the central banks, and central banks, it might not be well known, but central banks have been innovating for decades. I mean, the fact that we have today fast payment systems, RGTS, 24/7 type of payments is not casualty. It all owes to the central banks. But also the technology developments outside the central bank community has been traveling tremendously fast, even too fast. And yes, as you say, central banks do not want to be left behind. And as a matter of fact, in many aspects, we want to lead. So the MED, obviously, will do our own research, but more than anything is what can we do as part of the central banking community, as the place where the central banks come together and try to address problems that are similar to others. One chapter that is outside the hub, the innovation hub, is the Cyber Resilience Center, which its name tells itself, is just to join forces to assure resiliency of financial systems in the face of types of attacks related, different types of attacks that we all know about them. Now, the hub is it's a unique initiative. It's a very decisive initiative for different central banks to join forces in joint ventures with the BIS to establish innovation centers around the world. Obviously, this is to benefit all the central banking community. It has three objectives. It's one, to scope, and that's the reason why we have it diversified geographically, technology developments around the world, try to digest what those technologies are and in what way can they affect central banking and financial markets. Second, to develop prototypes, ideas, research that more than anything can produce public goods for the central banking community. I mean, here the point is we don't want each central banks to invent the hot water. You know, the idea here is to join forces and for all the community to benefit from those developments. And also we want to develop a network of experts. Central bankers do not have necessarily all the experts. We don't have probably all the capacity, you know, to bring together experts like big techs and so on and so forth. But if we join forces, we will be able to fare much better. So I think that we are doing this quite successfully. Again, we will be having 8 centers by the end of this year, and that will put the BIS, I would say, leading this effort towards developing technology for central bankers. Now, CBDC, my own, I think probably where I have been more critical, if the term critical applies, is I try to reinforce the idea that today's fiat money works because there is a strong institution like a central bank that provides trust to money, and that's what makes money work in the world. And many private developments trying to substitute other types of currencies and not use a central bank currency ignore many of the elements, many of the fundamental aspects that central bank bring to payments and to financial systems, among them the finality of payments. So the only one who can bring that to the table in a forceful way is the central bank, is our central banks. And given that we have the technological capacity to do it, I think that the best possible solution is for central banks to put on the table central bank digital currencies. That doesn't mean that there is no space for collaboration with the private sector. As a matter of fact, for me, a preferable scheme is a tier system where central banks provide the basic currency, but then the private sector can build on that. I'll stop here.
Right, just quickly before I turn to Jens Wiedemann, I'd like to ask you though, I mean, we already have one CBDC so far in the world, which emerged from the Bahamas. You've done a fascinating survey just recently of central banks, which showed that most are working on it, but you say that about 1/5 of the world's population will be in a country with a CBDC in 3 years' time, according to this survey. Do you think we're going to see CBDCs emerging as a serious force in the next 2 or 3 years, you personally, when you look at the discussions going around the BIS Innovation Hub?
Most central banks are approaching this not as a race. I think here this is a huge step forward. CBDC is something that has tremendous complexity. And there is one particular issue. It cannot fail. It cannot fail at any particular point in time. And to assure that type of resiliency, it takes a lot. It has many implications for the architecture of the financial system, for monetary policy, for monetary policy implementation. So it's the type of thing where there doesn't seem to be a real urgency for a CBDC to be put on the table tomorrow. What is necessary is just to have a medium-term horizon, but make sure that it's top quality and that there is no room for mistake. So as it has been said before, this is the type of problem where it's better to go slow because we are in a hurry.
Right. Well, Ruben, I'd like to ask you from the European perspective how you see this, because you've given a series of speeches recently on this point, warning about the danger of crowding out the private sector if the central banks come in and try and dominate it. You've suggested that actually any CBDC would have to coexist next to cash. And you've also pointed out some of the fascinating implications for the banking sector if the CBDCs come in and essentially disintermediate the private sector banks. So I'm curious, do you expect to see the Eurozone adopting a CBDC within the next 2 or 3 years? And how do you square the difficult circle of issues that you've raised in your speeches recently?
I guess the short answer is the time horizon that you highlighted is certainly too short, but my forecast would be that we are all seriously working on CBDC, and a lot of central banks will, of course, introduce also CBDC over the time to come. But let me just give you a bit longer response to your question, because I think this whole debate about crypto assets, stable coins, or digital money more broadly illustrates one thing first and foremost, which is that the need of consumers, but also the preference of consumers might change. They are looking for convenient, fast, internet-ready, seamless payments. And in that sense, I think, like Augustin said, my first approach would be that it is our responsibility to provide the backbone of those payment systems and to keep them state of the art, and then for commercial banks to offer the services based on this backbone, and also to provide the interface with customers. But that's also, I mean, that's, I think, the general operation of the system, and that is what we should not question fundamentally. But there are, of course, other developments that bring CBDC into play. One is that cash, the use of cash, which is a claim on the central bank, so the only claim that the general public can hold, is declining. So I think it is worthwhile reflecting of what that means and whether we should substitute that paper claim with a digital claim. And also CBDC might raise market efficiency, allowing, for instance, to execute automated payments and to use the central bank currency in smart contracts, for instance. And there's also, of course, the aspect of financial sovereignty. So as Augustin, I think, indicated, I think it's worthwhile disentangling the debate into two components. One is the currency part, where I think we should be quite self-confident. What we have to offer is a stable currency. And a lot of the more successful modern means of payments are linked to our legal tender. And then there is the technological part, which is interesting, and we should focus on that part. But at the same time, we central banks face a very difficult trade-off when it comes to CBDC. Of course, money relies on network effects. So the more widely it is used, the better it is for everybody. So basically, this means that we should increase the attractiveness of CBDC. On the other hand, and you mentioned that already, CBDC could come with some potential side effects and risks. And to mitigate those, we would need to reduce the attractiveness of CBDC. And one of those risks that you mentioned and that I highlighted in my speeches is the risk of disintermediation. I mean, CBDC would become a very close substitute for bank deposits. And in times of stress, the attractiveness of CBDC versus a bank deposit would even increase, which could mean that the danger of a bank run increases. And it also means that we have a sort of stronger reliance on refinancing through the central bank. So it means that the footprint of the central bank increases, our balance sheet increases in size, but also with the risk in our balance sheet might become larger. And this then leads us to this very difficult trade-off and to the discussion about restrictions on the amount you can hold in CBDC, but also on two-tier remuneration system. So the bottom line of what I wanted to say is that we should not try to crowd out the private sector, but we should rather also enable the private sector to offer the services that the consumer needs in this environment, which is heavily reliant on online commerce, for instance, which must be quicker than before, etc. And that's why we, as Augustin also alluded to, we invented. We have introduced in our target system, for instance, the possibility to execute instant payments. And there you're very close to the finality of payments that Augustine mentioned, but with commercial bank money. So I think there are other ways to satisfy the need of the consumer or firms than central bank digital currencies. So there's no rush or no urgency to introduce CBDC. I think it's rather something we should reflect on quite carefully, and that's what we all do.
Just one quick question before I turn to Jay, which is very European specific, which is some people say that Europe needs a CBDC to actually accelerate meaningful integration across the Eurozone of the payment system. And that would be really the biggest single reason to have it in Europe. What are your views on that? Are there other ways to get that meaningful integration, or do you actually need a CBDC to actually do that?
No, I think you're right in the sense that market fragmentation is an issue in Europe. And that's why a lot of the private payment initiatives face certain hurdles that are difficult to overcome. But we have seen in the recent past, for instance, the European Payment Initiative, which is a group of European banks and payment providers who joined forces to exactly provide that European, pan-European wide approach to overcome this market fragmentation. So CBDC, again, is not the only answer. There are also private initiatives. And I would even argue that if fragmentation is an issue, my first thought would go towards regulation and what can we do to overcome this fragmentation through regulation.
Right, right. Well, thank you. Well, I'd like to turn to Chairman Powell at this point and ask what you're doing in this respect, because you're currently in a very interesting position, Chairman Powell. You know, on the one hand, you have some politicians in the US warning that if the US does not accelerate its activities in this area, you're going to see China and others create digital currencies, which could threaten the dollar. You're seeing people like Gary Cohn, formerly of the White House, warning that the US is lagging behind in financial innovation. And yet at the same time, you have a lot of the establishment looking with great nervousness about what's happening in Silicon Valley and saying we cannot let things like Bitcoin go completely spiral out of control. So how is the Fed trying to square the circle? And what exactly are you doing in Boston with MIT right now in relation to the CBDC discussions and developments?
Thank you, Jillian. Well, there's a lot in that question. There are several questions in that question. So let me try to go through this. First, I want to say, applaud really Augustine for making technology and innovation a central focus of his leadership of the BIS, including the Innovation Hub and the other things that he mentioned. I think that was a very wise and insightful direction, and I think it's already providing significant benefits. I would also say, as far as CBDCs are concerned, two things follow for me from the dollar's status as the world's principal reserve currency. The first is that we have an obligation to be on the cutting edge of understanding the technological challenges as well as the potential costs and benefits of issuing a CBDC. And we are, as I'm happy to share with you, exploring all of this. We're not in a mode of trying to make a decision at this point. We are experimenting with technology, discussing policy, and all of the things that have been discussed by both Augustine and Jens. But the second thing is, because we're the world's principal reserve currency, we don't need to rush this project, and we don't need to be first to market. A dollar CBDC would have potentially large implications here and around the world, and we'll be sure to think carefully about all of that and engage very broadly with the public around the world, and particularly here in the United States, before we even approach a decision. So let me come to the United States and how we're actually thinking about this. So if I can just provide a little context. Today, the public can own central bank money in the form of currency, and financial institutions can own central bank money in the form of reserves, which are digital. Banks offer digital money in the form of bank deposits. And although they're obligations of commercial banks and not of the central bank or the government, they're backed by the federal deposit insurance up to $250,000, giving them characteristics of trusted money. So that's the world we're in. It's also a world in which there's tremendous innovation in the payments area. We're going to have ubiquitous instant payments very soon. People will be able to make a payment immediately in immediately available funds rather than waiting hours, days to clear. And these improvements are being driven by both private and public sector actors. So we want to foster that innovation, but we want to assure through regulation that the public is protected. So does the public want, the real threshold question for us is, does the public want or need a new digital form of central bank money to complement what is already a highly efficient, reliable, and innovative payments arena and system? What exactly is the need here? How can we address it? What are the costs and benefits of adding a CBDC to the mix at this time? So the potential benefits could be more efficient, more inclusive payment system, and consistent with our essential ongoing role as the issuer of the trusted currency, the sovereign anchor, which provides so much benefit. And I think we all agree on that. But there's significant risks as well. There's the cyber risk, there's money laundering and terrorist financing. In addition, the financial stability risks that Jens mentioned, we don't want to destabilize the two-tiered system. We're sort of purveyors of stability, macroeconomic stability, price stability, financial stability. We have a two-tier system. Central banks interface with banks, banks interface with the public, and we do not want to destabilize that. And therefore, we don't want to compete with banks for funding. We also, in a time of severe stress, don't want to create the basis for a run. And so there's just a tremendous amount of thinking going on how we can capture the potential benefits while also managing those potential risks. And in the BIS work that we've done with other central banks, we identified 3 principles, the first of which is do no harm, the second of which is coexistence of a central bank digital currency with commercial bank money and cash, and the third of which is fostering innovation and efficiency. So now you ask about what we're actually doing, and I'll wrap this up in a second, but what we're doing is a broad program of experimentation and investigation about whether to issue a CBDC, and if so, how would we resolve the many design choices to be made in light of those potential benefits and risks. So we're collaborating with other central banks at the BIS and elsewhere. We've also, we've got at the board here what we call the Tech Lab. That's a multidisciplinary, it's a virtual group across more than half of the reserve banks have active work, way more than half on central bank digital currency. I won't try to name them because I'll leave somebody out. If I do that, that would be a mistake. Doing various things. You ask about Boston. So we're collaborating with MIT on a multi-year effort to build a hypothetical digital currency for central bank use. It's intended to support our broader efforts, obviously. So the focus really, though, is on developing an understanding of the capabilities and limitations of the relevant technologies. It's not an attempt to create a prototype. In effect, they're saying, let's try to build the basis for a central and see what we learn for a CBDC, and we'll see what we learn. Atlanta's very active. I won't mention, as I said, but ultimately the bottom line is to move forward on this, we would need buy-in from Congress, from the administration, from broad elements of the public. So when we haven't really begun the job of that public engagement. So you can expect us to move with great care and transparency in considering a CBDC, as is our obligation, and we're doing that now.
So just as a matter of curiosity, and I'd like to ask this question to Jens Wiedemann as well, one of the things that came out of the BIS's survey, which is fascinating, is it's not clear whether it's even legal in many jurisdictions. I think half of the central bank survey said they weren't sure. Is it legal to create this kind of thing at the moment in either the US or Europe? Chairman Powell and then Jens Wiedemann?
You know, we would, that's a good question. And we would not proceed with this without support from Congress. And I think that would ideally come in the form of an authorizing law, rather than us trying to interpret our law to enable this. So I think that's how we would look at it.
What about the situation in Europe? Is it legal in Europe?
I think by the time we will proceed with, or if we proceed with the central bank digital currency, you can be sure that the legal basis will be sound. And I think it's important to engage with the broad public also about the potential benefits and also side effects. And that's exactly what we've done during the consultation that we've conducted in Europe. And now after this phase, I think we need to engage also more with the legislative, but also explaining what a central bank digital currency can and cannot achieve. And again, my point from before is we shouldn't focus solely on central bank digital currency when we talk about modernizing the payment landscape. I mean, what we did, for instance, on our side here is to team up not only with our finance ministry, but also with representatives from the financial industry and the so-called real economy to explore what other avenues would be fruitful to investigate. And I mean, some of the beneficial effects of a CBDC could also be achieved, for instance, through tokenized commercial bank money. I mean, if we're talking about automated payment, programmable money, that must not, need not necessarily be a CBDC. And we're also here at the Bundesbank currently having a project that works on a so-called trigger solution. So we would have blockchain, private blockchain that triggers payments in our Target 2 system in central bank money. And I think the main point, as Jay already mentioned, is that would preserve that two-tier system. At the moment, we distribute our central bank money to our to the commercial banks, basically, and don't engage directly with retail customers. And in that sense, with that trigger solution, we could preserve that two-tier system. And I think we should explore those solutions as well, which are less invasive in a sense and less disruptive than CBDC before we take that step to introduce CBDC.
So that way you avoid just intermediating the banks in a way that will create a new set of financial headaches. I guess one of the big questions, and I'd like to ask this maybe to Augustin and the others, is to what degree is this conversation about CBDCs or alternative token-based solutions, stable coins, to what degree is this really an attempt to fend off the unwelcome financial stability threats created by innovations like Bitcoin? Are you concerned about the financial stability implications of those, and is this an attempt to fend that off? Maybe Augustin, you can ask that, and then I'll like to ask that to Jay and to Jens.
Well, yes, certainly there is a financial stability risk there, a financial stability consideration there. There is also this element of having arbitrage between a very regulated, supervised system as the one that depends on the centrality of central banks, even if it's a two-tier system, in a system where, you know, for example, no AML-CFT considerations are anticipated. No, other important aspects there is that in stable coins, I mean, for example, take the idea of stable coin. Stable coin says that they need to have backing to guarantee its value. So it needs to import value from a third, from another type of asset. So how could that be superior to the original asset that is providing value? So there by itself, it's a weakness. And if you see through history, different manifestations of ideas similar to stable coins have failed, because at different points in time, the backing of those currencies have not been there at the appropriate moment. And of course, as both Jay and Jens have mentioned, central banks are there to provide stability. Therefore, we cannot support ideas that inherently have elements of instability there. And that's why, you know, the name of stable coin, they have to put stable there because otherwise it's not stable. And to get that stable there, they need to import it from some other place. So that for me is a very, very important drawback of those things. A good thing that the ideas have is that they have developed very nice technology there, and there are ideas there that should be rescued, and that's why I like to speak, and many of us like to speak about public-private partnerships, where we bring together what central banks can put on the table. Nobody else can do that. And at the same time, we need to be able to exploit the innovation, the drive of the private sector. And I think that's the way we can have a modern, top-notch payment systems with the most security.
So basically what you're saying is that you're trying to out Libra, or take all the great ideas coming from Silicon Valley and transplant them into central banking, as I said, making central bankers cool. Jay, I'd like to ask you, Chairman Powell, sorry, I'm dealing with different forms of address and cultural expectations. I know in America, everyone uses titles. In Europe, they don't. So apologies if I cause offense to anyone watching by addressing you wrongly. But I'm curious, Chairman Powell, are you essentially trying to beat them at their own game? To what degree do you see things like Bitcoin or Libra representing financial stability threats that you're trying to get ahead of?
First, I spent 9 years here trying to get people to call me Jay, so please.
Okay, that's kind of been cool.
let me say, yeah, absolutely. Let me just take a step back and say that our work on CBDCs is not primarily motivated by the appearance on the scene of cryptocurrencies and stablecoins. It really is fundamentally, technology has made it possible for us to offer a new form of trusted money and that sovereign anchor that has been so important for economic development for a very long time. And we're looking carefully at whether to do that. So turning to your question, crypto assets, which we call them crypto assets, they're highly volatile, see Bitcoin, and therefore not really useful as a store of value, and they're not backed by anything. They're more of an asset for speculation. So they're also not particularly in use as a means of payment. It's more a speculative asset that's essentially a substitute for gold rather than for the dollar. And I think with crypto assets, the public needs to understand the risks. The principal thing is there's the volatility. There's also the outsized energy requirement for mining, and the fact that they're not backed by anything, which I mentioned. Turning to stable coins, so to the extent a stablecoin is backed by sovereign currencies of leading nations, that's certainly an improvement over crypto assets, I would say. But nonetheless, where does the credibility come from? It comes from that sovereign currency that is the backstop. The thing is, existing sovereign currencies are issued with the benefit of the public in mind. The potentially fast and wide adoption of a global stablecoin, potentially a global currency governed only by the incentives of a private company, is something that will deserve and will receive the highest level of regulatory expectations. And is regulation where it needs to be on global stablecoins yet? It's not, but we're making progress. Nonetheless, stablecoins may have a role to play with appropriate regulation, but that role will not be to form the basis of a new global monetary system. Private stablecoins are not going to be an appropriate substitute for a sound monetary system based in central bank money. And I'll stop there.
Right. Jens, how does it look from the perspective of the Eurozone? Because, of course, one of the things that I think is, particularly, sparked particular angst in Europe is the fact that so much of this innovation is coming out of the US or China rather than homegrown, which raises all kinds of issues about privacy concerns, because, of course, privacy expectations are very different in Europe. But, are you concerned that this poses a kind of financial stability threats that you have to head off in terms of the swings of value of Bitcoin or things like that?
No, I think our perspective is pretty similar to that of Jay and Augustine. I think the main point here is, if you talk about the means of payment, and that was our focus so far, then stability is a precondition. You cannot have a useful means of payment or a store of value if the underlying asset is widely fluctuating in value. And that's why, that's why basically sometimes this discussion conveys the impression that Bitcoins are widely used to transform transactions. But that's not the case. It's mainly, as Jay said, a speculative asset. And I'm not sure when you effectuated your last payment in Bitcoins to purchase a newspaper around the corner or something on the internet. But I think most people will just say they didn't. And that's why the discussion now slowly shifts towards the stablecoins, because they are lending the stability from the legal tenders. And again, my point is, we have to look. We provide the stability to the system, but we can learn from those providers by looking at their technology and exploring whether this technology might make sense also in our environment.
Right. Well, I'd like to turn to a slightly different aspect of innovation that I know that the BIS is all over. And again, I do think it's absolutely fascinating what the BIS is doing with their innovation hubs, not least because it's shifting the geographical balance towards Asia and elsewhere. But the question of AI. We've had this big drama explode in the last year around Ant Financial and Jack Ma. And obviously a lot of that is to do with the issue of internal politics and the regulatory approach taken by Beijing. But at the heart of that story is also the question that affects everybody, which is what is going to happen to credit scoring in a world where financial institutions are using AI to make credit judgments to a degree that essentially outstrips the ability of regulators to watch and potentially changes finance very dramatically. Suddenly, central bankers are going to have to become technologists, data companies, and so are private sector banks. To what degree do you think, maybe I can start with Jay on this one, to what degree do you think the US regulators are actually awake to these issues around AI and credit scoring and the changes in the financial system? And how can the Fed respond to that?
We're very much awake to that set of issues and very focused on that set of issues. And the issue, it really comes down to algorithms that allocate credit. That everyone's using these very fast turnarounds. And what you find is, in many cases, it's an algorithm. It is acting in a discriminatory way because of the way it's constructed. In other words, in a way that discriminates against certain people without any economic basis. And so, we're very focused on that issue. We've met with, the top data scientists at all of the private companies that are not even ones that are not in the, the financial sector. And we've been working on this for a couple of years now and providing guidance and understanding. And financial institutions do have to understand that their algorithms have to work and have to allocate credit in a way that doesn't discriminate against for non-economic reasons, even inadvertently, because it's an algorithm. It doesn't know what it's doing, but nonetheless, the result can be discriminatory. So it's not an easy issue, but the banks are quite well aware of it, and we are. And as I mentioned, we've got top data science working on it here and in the private sector.
What about in Europe, Jens? Is there concern that moving to credit allocation on the basis of AI and other forms of credit scoring is going to create new financial stability threats?
I think we're very aware of the issue, and like Jay said, there are those ethical questions, the discrimination that can come with it, but also other financial stability issues that haven't been mentioned so far, which is a dependency on third parties in some aspects of these markets. There's cream skimming that might become an issue with those algorithms. So, and this comes on top of a potential herd behavior, of correlated risks. So there are risks that we are very concerned about. At the same time, those algorithms also present advantages that we should consider. And one of them is, of course, that they also allow access to credit for those with a limited credit history, for instance. They also allow a better risk diversification and risk sharing, if you think of those credit platforms. And basically, they help reducing costs in the banking sector. So at the end of the day, it's about weighing those benefits and costs and making sure that the banks have the proper internal governance mechanisms in place, that they understand the risks and take them into account.
Right. One thing I'm curious about, I'd like to bring you in, Augustin, here and ask, Jake observed last week that COVID-19 crisis had accelerated pressure on central banks to collaborate around this, whether it's either the payments issues and trying to get some kind of more global consistency, whether it's talking to each other about how they're going to back some kind of stable coin or deal with these credit scoring questions. I'm curious, Augustin, do you think COVID-19 is going to be an accelerant to these discussions in terms of what the BIS is doing in relation to?
Yes, I think COVID-19 changed the world, changed the landscape. Many policies that were implemented, rightfully so, have produced very good results. But the evolution of the crisis itself has led to uneven results. You know, I mean, for example, the incidence of the crisis on some sectors have been much larger than in others. Therefore, I think it is important to consider what are those side effects, and in no matter in which field you are talking about, payments, credit, income, you know, inequality is not conducive to good results and good policies. Therefore, we need to take them into account and level the playing field as much as we can. Therefore, I am convinced that we need to be looking into ways where we can level the playing field, given the instruments we have. And we need to have a balanced approach. I mean, I think going back to the discussion we just had about the algorithms, I think that the point that Jens made, that the algorithms have also good aspects, is very valuable. We have written a paper here, the very good paper in the BIS, that basically makes the point that the data can substitute for collateral. And oftentimes people cannot get credit because they don't have the right collateral that institutions have. But the adequate set of data can substitute for that collateral. So we have to think also creatively how those algorithms can be incorporated, without forgetting that an algorithm is code with opinions.
I would say it's a code with culture training, and someone who's trained as an anthropologist, fascinated by how the anthropology of the central banking tribe and the financial system is so important. But I'd like to quickly ask you, Jay, when you said that you thought that COVID-19 would accelerate these discussions in your speech last week, what did you mean? Did you think that the crisis has exposed some of the weaknesses in the payment system globally?
Yes, so I would say maybe in three ways. First, at the absolute acute phase of the crisis, there was a need to get support payments to people quickly. And you know, our regular way payment system, which gets things there in a few days, was challenged to deliver massive millions and hundreds of millions of payments really quickly. And there was a sense that people were, and you could see spending pick up immediately after the payments arrived. So people were really, with their companies closed down and on furlough, they were in need of quick payments. So speed is one thing. Another thing just is people need to be able to access the financial system remotely because people weren't going to banks. And so that's important. The third thing is what Augustine said, which is it highlighted across a whole range of things the disparate impact of so many things on poor, lower, moderate income communities. And in particular here, it highlights the importance for greater inclusiveness in our financial system. People who are less likely to have remote access to their financial services and in dire need of quick support at times. So I think it underscores what is already a high priority for us, which is the need to have more inclusive payment system and a more inclusive economy.
Right, thank you. Well, thank you to all of you for a very interesting discussion. Frankly, I think we could talk for another hour at least, because there are so many huge issues raised here. And that's not surprising in a way, because we are seeing an extraordinary confluence of innovation and finance right now. It really is quite a historic moment, made more intense, potentially more angst-ridden by the degree of political upheavals, by the degree of changing patterns of globalization, and by the rising expectations that the public have when they look to central bankers. So you have your work cut out in the coming years, to put it mildly. I commend the BIS Innovation Hub for trying to grapple with these issues. The very fact that I've struggled to cover even half of the issues in 45 minutes indicates the breadth and magnitude of your work. And as Jay just said, the COVID-19 crisis has in many ways accelerated the spotlight on these questions. So thanks to all of you. Best of luck to both the Bundesbank and the Federal Reserve in trying to navigate a path through this, and other central banks. and very best of luck to the BIS in trying to forge a common collaborative solution. Let us hope it's not like trying to herd cats, but it's certainly going to be a challenge in trying to make, if not central banks dance, then to make them truly 21st century and innovative. So thank you very much indeed to all of you.